Thank you for tuning in to Investment Insight presented by McCay Wealth Advisory. My name is Hayden Profit. Joining us today, we have Brent McCay. Brent, why am I getting notifications of trade confirmations with Charles Schwab?
So that's a great question. So on Wednesday, August 21st, we did our first rebalance for 2024. In that rebalance, we sold large U.S. companies and large developed international companies. And we purchased mainly small and mid-cap investments, small mid-cap stocks, and emerging market investments, and investments that were historically below target percentages and historically cheaper. So large U.S. companies and large international companies are trading in the mid-20s from an earnings perspective, so about 20 times profit, a little bit more than that actually. Historically, they traded about 19 times profit, and we're now closer to the mid-20s. And smaller U.S. companies tend to trade in the upper 20s times profit, so in the 28 times profit range. And right now, they're trading in the 15 times profit range. So the theory goes that if interest rates go down, smaller companies should benefit from being able to borrow money with less interest, and their profits should rise. And so if we go into an environment where interest rates are dropping as inflation has gone down, then that should lead to these smaller companies to over or outperform larger U.S. companies. Another part of the rebalance is, and you may have noticed this, is there's a lot of cash in a lot of people's accounts. Now, part of the situation is when you have dividends and you have interest that pays into your account, that money sits there until we invest it in something. And so one of the things we also did in our rebalance is we picked up excess cash above the 0.5% mark to get that money deployed in investments earning interest. And so people always ask the question, like, why do we have cash? Why do we have 0.5% of our money in cash? Well, the reason is when we sell an investment and we buy another one, there's a little bit of a lag there. There could be 10 minutes to do a trade. And it's very easy for markets to move 0.5% in 10 minutes. And so historically, we used to keep over 1% of our portfolios in cash because of the gap. We've gotten better at executing our trades quicker, and so we've been able to keep less money in cash. But we hate money in cash because it doesn't earn much interest.
Yeah.
Another big question people ask is, when is the likely next rebalance?
Yeah.
Well, in October of last year, we acquired some bond investments for the longer term with higher interest rates. The idea being that while the 10-year Treasury was exceeding 5% and some of these bonds were in the upper 7s to 8% ranges, that we would lock in interest at higher rates before the rates came down. Because historically, interest rates are about 5%. And so that gave us the ability to buy stuff that was historically high from an interest rate perspective. Our belief is that interest rates will start going down as we approach the 2024 election to try to speed the economy up to A, avoid a recession, and B, encourage people that are currently in office to retain their positions. And so our belief is, from a strategy standpoint, that if those rates do go down and we can lock in money, profit, off of having that higher rate, that we would then sell those investments once we hit the long-term capital gains mark and then switch into shorter term, because there's a very strong possibility that the Federal Reserve will err, cut rates too much, cause the economy to boom too much, cause inflation to come back, and a slight repeat of what we saw in 2022.
Right, and what is the long-term capital gain time frame?
So usually, once you've had investment a little bit over a year, that's where it switches from short-term to long-term capital gain.
Gotcha. And that otherwise would be picked up in ordinary income.
Yeah, and people ask the question, well, I've got my money in an IRA, why do I care? Well, the benefit of trading our models is we trade everybody together. So we want to use IRAs and non-qualified accounts together because when we're buying in blocks, we typically get a better price point on our trades than if we do it individually. So historically, in the recent history, we have done all the trades together to try to get the benefit of scale. The more money we have to trade, the lower the cost is to execute that trade.
Right. Well, perfect. Well, thanks for talking to us today about the rebalance, and thank you for tuning in today. I hope you have a great day.